Welcome to this explainer. Today, we're diving right into the latest Inland Revenue Authority of Singapore guidelines to keep your business totally compliant and, more importantly, penalty-free. I am super excited to walk you through this crucial info so you can handle your tax obligations with absolute confidence. Let's get right into it.
So we've got to start with the absolute most critical question for any Singaporean business owner right now. Is your business on the IRS audit radar? With the tax authority really stepping up their reviews to make sure everyone's paying their fair share, it is absolutely vital to know exactly where they're looking and, what they're actually looking for.
Here's how we're breaking this all down today. First, the GST audit radar. Then, missing trader fraud, followed by low-value refund claims, non-residential property sales, sole proprietor under-declarations, and finally, voluntary disclosure.
All right, Part 1, the GST Audit Radar. Let's look at how IRS actually uses a risk-based approach to keep things fair across the board.
So, IRA doesn't just pull names out of a hat. They conduct regular audits that are specifically tailored for higher-risk industries. It's all about encouraging voluntary compliance. They actively identify key compliance risks. Basically, if you happen to operate in one of these targeted, higher-risk sectors, your records need to be absolutely pristine. They rely on heavy data and a really targeted methodology to design these specific audit programs. They aren't guessing, they're following the data.
Moving on to Part 2, missing trader fraud. Now, this is where things escalate really quickly from, say, a simple paperwork error to major criminal activity.
So what exactly is missing trader fraud? Well, it's a fraudulent scheme used by syndicates to basically defraud the government of public revenue. Singapore takes this extremely seriously because it's a massive threat to the whole system. You've got to carefully scrutinize your purchases and do proper due diligence on your supply chains. If you even accidentally get drawn in and suspected of being involved, IRS is going to investigate you, freeze your GST refunds, and deny your input tax claims right out of the gate.
The stakes here are literally massive. If you're convicted as a mastermind, a co-conspirator, or even just a participant in a syndicate, you could be staring down fines of up to $500,000.
And if that doesn't make you sweat, that huge fine can also come with up to 10 years in prison. 10 years. And here's the real kicker. Please don't think this only hits the masterminds. Unsuspecting current or former sole proprietors, partners, or directors whose business entities are used in these schemes, they can face up to 12 months in prison and a $50,000 fine themselves. You absolutely have to know exactly who you're doing business with.
Okay, let's take a breath and move to Part 3, low-value refund claims. Stepping away from the syndicates, this is a much more common trap that trips up everyday businesses.
These are those simple, seemingly innocent mistakes that trip up honest folks. To stay compliant, you can never, ever claim input tax on predominantly private or explicitly disallowed expenses. We're talking motor car expenses, personal medical bills, home utilities, or family food costs. Treating your family to dinner is great, but sadly, it doesn't count as a business expense. And just a heads up, when auditing this stuff, IRS might actually visit your premises and interview your staff just to verify that your real-world operations match what's on your paperwork.
Let's ground this with a real-world example straight from the guidelines. So even if you run your business 100% out of your residential home, you absolutely cannot claim input tax on housing-related expenses. In this first case, Company ABC tried to claim utilities, phone charges, and maintenance fees for their home office. IRS stepped in and completely disallowed those claims, ruling them strictly personal in nature.
It's also all about documentation. If you're making zero-rated supplies because you're exporting goods, you must have the proper paperwork proving those goods actually left Singapore. In our second case, Company XYZ couldn't produce their export docs. No proof, no zero rating. IRS wasn't satisfied the goods actually went overseas, so they just charged the standard GST rate to recover the funds. Honestly, paperwork is everything.
Right, Part 4, non-residential property sales. This is our third big compliance pillar, dealing with the rather dense rules around selling business assets.
When dealing with these properties, timing is everything. It all depends on the type of payment you receive. If you get an option fee or a deposit, you have to account for GST on the earlier of two dates, when the payment is actually received or when the invoice is issued. For the remaining sum, it's the earliest of four events: invoice issuance, payment receipt, legal title transfer, or the physical handover of the property. It's like a timing puzzle you have to get exactly right.
So please, whatever you do, do not wait until the legal completion of a sale to account for an option fee.
That timing error is basically a giant flashing red flag for an auditor. Another massive mistake? Forgetting to charge GST when transferring property without receiving payment if you previously claimed input tax when you bought it. Every transaction needs to be accounted for perfectly.
Now for Part 5, Sole Proprietor Under Declarations. A lot of folks mistakenly think only their quote-unquote primary business is subject to GST.
Here's the deal. Your GST registration is under your personal name. That means every single side hustle, freelance gig, and business asset sale has to be included in your returns. It is incredibly easy to forget to declare taxable turnover from, say, driving a private hire car, running a hawker stall on the weekends, doing some property agent work, or freelancing as a fitness instructor. But all those different revenue streams, they all combine and must be declared under your single GST registration.
Finally, Part 6, Voluntary Disclosure and Penalties. We've talked about the traps, but now we've got to discuss the severe tripwires and, most importantly, your ultimate escape hatch. Ignoring these rules? Yeah, it leads to some truly staggering penalties. If you submit incorrect GST returns, you could be looking at penalties of up to double the tax undercharged. And it gets worse. Upon conviction under Section 59 of the GST Act, you could be slapped with fines up to $5,000 and face up to 3 years in prison. 3 years! These are totally life-altering consequences for what could literally just be sloppy bookkeeping.
So, before we wrap up this explainer, I want you to take a second and genuinely ask yourself, are my business records actually bulletproof? Take a hard, honest look at your past returns. Are you absolutely certain you haven't accidentally claimed personal utilities? Have you bundled in all your freelance cash? Do you have every single export document filed securely away?
If you do find a mistake during your own review, don't panic, but do take action. Use the voluntary disclosure program right away. It's your safe escape hatch to protect yourself and drastically reduce those penalties. By stepping forward and telling IRS about an error before they come knocking for an audit, you're demonstrating good faith. So, review those files today, make things right, and secure your business's future. But honestly, it does make you wonder, what hidden tripwires might be buried in your own accounting software right now, just waiting for an auditor to uncover them?